And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. And of course, we're going to go deep into some very interesting topics today, including exchange-traded funds, but also ESG, environmental, social, and government. Huge inflows into ESG this year, and especially in May. Huge inflows into ETFs in general, but especially ESGs. So we're going to talk about that. Joining us to discuss that, the man who runs the biggest ETF family in the world and the biggest ESG suite of products. That's Armando Senre, the head of BlackRock's iShares Americas, along with Sal Bruno, the chief investment officer of Index IQ, who also runs an IQ ESG ETF as well. That's also outperforming the S&P 500. And my old friend Todd Rosenbluth from CFRA. Armando, I've got used to saying amazing inflows into ETFs, but amazing inflows into ESG again this year. I'm looking at ESG inflows in the first quarter of the year, 21 billion in inflows into ESG funds. There was 21 billion in all of 2019. So we've already done the first quarter of this year has already had the same flows as 2019. I know we keep saying, well, there's a new generation of investors and they're interested in climate change. Is that really it? Does that explain this avalanche of money coming into ESG, or is there something we're sort of missing? Look at these numbers here going up every single year, every single quarter.
Yes, Bob, and great to be here. Let me just say that I don't think it's that. I think that it's the realization that investment risk and investment performance, that's what ESG is about. It's not about compromising performance, and it's not just about values. So it's that convergence of values with the realization of investment risk and investment performance. So what you see is more investors incorporating sustainability into their portfolios, thinking about how ESG-related risks may have an impact on their portfolio and therefore on asset pricing. I think that that's why you see this massive increase in flows. And by the way, we think that we're just at the very beginning. Yes, in iShares, we just crossed 100 billion in sustainable ETFs globally. Half of that coming from the US. So this is no longer a European story. This is a global story. We see the same thing all around the world. But the reality is we believe the category will be $1 trillion by 2030. So we're just at the beginning. How does that happen? You see here in the US, you see a lot of model portfolios in the wealth segment incorporating ESG into the model portfolios, not only in sustainable models, but also in traditional models. So beginning to incorporate sustainability in their traditional models. And you also see it, as we talked before, with large asset owners around the world incorporating sustainable in their portfolios, like in the case of LCTU, we talk about CalSTRS. So that's what's driving the growth, and we're just at the beginning.
Yeah. Sal, you also run an ESG ETF, the IQ ESG ETF. The symbol is IQSU. You've been outperforming this year, also big inflows. And maybe pick up on what Armando was talking about there, not just climate change, but there's gender equality issues. There's the whole stakeholder versus shareholder issue. This is sort of that perfect confluence, as well as, of course, a younger generation of people that are interested in this. But pick up on what Armando was talking about there and why we keep talking about ESG as the moment that it's having right now.
A lot of what Armando is saying. And for us, we think that this is the acceleration and continuation of the trend that we had seen basically going on for several years. But if you even go all the way back, to 15, 20 years ago, if you think about what ESG investing was back then, it was really only about excluding certain types of companies. And that has evolved so much more so that it's really more of a comprehensive or a holistic view of, you're right, the stakeholder versus shareholder issue. And that's why we've partnered with Candrium, who's one of our sister boutiques under the New York Life umbrella. They have a long history of doing the ESG investing over in Europe to try to find best-in-class type of companies that cut across E, S, and G. And to us, I think an important part of this evolution is the fact that ESG investing went from being a satellite or a fringe type of an investment strategy to much more of a core type strategy. And we're seeing a lot more investors using it in their core piece of their portfolio. So they're looking for things like very competitive fees, lower tracking error, competitive performance. It's really those days of the question of do I have to sacrifice performance to invest according to my values? Those days are kind of gone. We're seeing these types of strategies with lower tracking, competitive, very low fees, actually putting up competitive performance. That's what we've seen in IQSU, the ETF that we have launched.
Yeah, Todd, you see what's in this ETF, the main holdings, and this is something you and I have talked about many times. You pry open the door of most of these big ESGs, and their top holdings tend to be big cap tech, mega cap tech, or at least high quality big cap tech names like Johnson & Johnson shows up all the time. Can you help explain that to me? And maybe Armando could step in too. I've asked him about it, but it does bother me a little bit. And people keep messaging me saying, Bob, is this all anybody can think of to put in their ESG funds is big cap tech? Why do they keep going in, passing the test and going in? And is there anything else that anybody can include there?
So these are broadly diversified ETFs for the most part. And as Sal just touched on, their goal is to have relatively low tracking error, meaning they're going to perform relatively in line with the broader market. In this case, we've actually seen these two ETFs that we're talking about outperforming within the past year. You tend to have less exposure to energy or slightly less exposure to energy. You tend to have slightly more exposure to some of the more growth-oriented sectors like technology and like consumer discretionary. But it's more what you find not in these portfolios as opposed to what is in there. These are still market cap weighted in nature. So you're going to be heavily weighted towards the Apples, the Microsofts, the Alphabets, but you often don't find Facebook within some of these portfolios in Sal's product. In IQSU, you don't find JP Morgan or Facebook within the portfolio. So there are certainly companies that you won't find that would be in your broader core portfolio.
Yeah. So Armando, why don't you explain what's in your newest ESG fund, the Carbon Transition Readiness Fund? You just launched it 2 weeks ago. You've got $1.3 billion in this. How do you decide what goes in this? What's the criteria? I mean, it's $1.3 billion for 2 weeks is a pretty impressive inflow. So somebody wants in on this thing. How do you decide what's in it?
Yeah, and I would just emphasize first what both Todd and Saad indicated, which is that when I mentioned the growth is coming from large asset owners and model portfolios incorporating sustainable, this is not just a niche allocation in the portfolio. These are broad exposures that provide a core allocation in the portfolio. So you have to look at your whole portfolio. Are you overweight large caps? That's a consideration, but you should not look for sustainable as if it's a different part of the portfolio that will play in a different space. So in the case of LCTU, which is the low carbon transition portfolio that you were referring to, that was the largest active ETF. That's actually an active ETF offering, but with a low tracking error, given investors exposure to the Russell 1000. So you have exposure to the Russell 1000, but with 50% lower carbon intensity. So that's the key. So you will still have a lot of those names. What do we do in the portfolio? We have about 350 holdings. We look at the holdings in the Russell 1000. We put them through a framework to analyze how those companies are doing in the transition to a low carbon economy. We have a proprietary framework that we use. We give different scores, and we overweight and underweight based on that. But you still get exposure to the Russell 1000. So again, is that broad exposure that you're looking for, Russell 1000 with 50% lower carbon intensity?
So that's the simple answer. When people keep asking me why are tech names showing up in these ESG funds so much, and particularly something like a low carbon, the answer is, well, they tend to be companies that have the lowest carbon footprint. I mean, they're not actually producing anything. Well, they're producing chips. So the next question I usually get asked, Armando, or anybody on this, Sal or Todd, is, do you account for the fact that, for example, Apple produces chips that are, of course, have carbon impact as well? Is there something down the food chain that is also considered when including these companies? I get asked this question all the time.
Yeah, we look across the value chain. We look at the company, at all these companies, across all their activities, across the materials that they use, the use of natural resources, and that's how we come across with different metrics.
Yes, I would agree. We look at that on the IQ side. Yeah, we look at the whole value chain and how companies, and there are companies, actually large cap companies like Netflix. Actually, one of the big reasons they're actually not in our strategy is that they have a significant negative impact on the environment through the high electricity consumption of their data service. So just a concrete example of something that actually has gotten filtered out for its environmental impact. Todd mentioned names like Facebook on governance issues. Amazon actually is one that we don't own. That's a very large holding in many of the others. And for there, it's been more for society, the S in the ESG, in terms of kind of the work issues that they have. And we also what happened with the unionization vote down in Alabama. So, we do try to look across all E, S, and G to try to identify companies. They need to be screened out so we can really get companies that are best in class across all three of those metrics.
Yeah, one thing that's very interesting, just to move on this, is it seems ESG is growing so fast that sometimes just managing the flows are an issue. So, Armando, I was looking at iShares Global Clean Energy that you guys run. This is a huge fund that's a real darling of the ESG crowd. And the benchmark, I believe S&P ran this, did the benchmark for this. They had to increase it from 30 stocks. It was a very concentrated fund, which I think is terrific, to 100, just because there was so much money flowing in. They had to be careful about reducing clustering, essentially. So you're sort of a victim of your own success here, aren't you? I mean, here's a very concrete example where ICLN had to expand the number of companies that are actually in there to accommodate all the people who wanted in on it.
What I would say is that iClean is a very specific thematic type of ETF. It's very different from the exposures that we talked about before. When you look at the LCTU, Russell 1000, when you look at the SGU, large cap, mid cap, those are broad exposures where there's no issues in terms of the flows. In the case of iClean, also index providers we're still in the early days. They're working in their methodology, and that's improving. That's been updated constantly to accommodate for the growing asset class that we have. But again, when you look at the category, we think that this is going to be a $1 trillion category by 2030. So we are still in the very early days.
Yeah, I think what we're starting to see, too, is the broadening out. I mean, we were talking a lot about kind of core holdings and lower tracking error products, and now we're talking a little bit more of satellite-type products where you're looking at some more thematic-type investments that maybe involve some ESG investing. So, for example, we brought out a strategy in February as the IQ Healthy Heart ETF, the ticker is HART, and it overlays the ESG screen, so we're only looking for companies that meet the ESG criteria, but it's very much oriented towards a specific theme. In this case, it's promoting healthy lifestyles through trying to address some of the issues with heart disease. So, we're looking at companies in the healthcare sector. We're looking at companies in the food sector that are actually providing better lineups of more healthy alternatives in their food, as well as companies that are involved in fitness tracking and promoting better lifestyles. So I think what we're talking about here is actually transitioning and broadening out the product suite, the product set, to think about some of these more satellite type of positions that are blending thematics as well as ESG together.
Yeah, thank you, Sal. And Todd, let me just turn to you. I want to move on to another subject. So the two topics I get hit all the time by investors at CNBC on this is, one, why is there so many tech stocks in it? We talked about that. The other is the lack of standards that are developed for ESG that bothers a lot of people, that they have to be very careful at looking at what these ETF funds actually are investing in terms of what they define as ESG. Todd, has there been any advancement in defining what ESG actually is and what it actually is doing? I know there's some groups out there like the Global Sustainability Standards Board that are out there, but are we any closer to an agreement on what ESG actually is, or should we not have an agreement? Should everyone have their own definition?
So I don't think we're that much closer. You're right. There are groups that are trying to have standardization. But I'm not sure this is any different than we have index providers that are behind this that classify companies as either growth or value. And often they'll agree with one another, but often they will not. And so a stock will be in the Russell 1000 growth and will be in the S&P 500 value because there's the data looks different, even though they've got different criteria behind it. This just comes back to you need to understand what's inside the portfolio. If what you want is a core product that's closely aligned to the broader market, and you're comfortable that the 5 largest stocks are the same 5 largest stocks in the S&P 500, but there's a lot of stocks that are not further down, then there's some great products. If you want more of an exclusionary product where it's much more narrowly focused, for example, iShares has an advanced series of products. What's inside those ETFs and what's inside the aware ones, like the SGU, are quite different.
Yeah. Another thing I've noticed, and I'll throw this out to anybody, Armando, maybe you can handle it first, is what's sort of not hot this year. ESG remains hot. Last year, everyone was falling all over themselves for thematic tech ETFs, not just clean energy, but 3D printing, cybersecurity, solar, cloud computing, for example. This year, not so much. Maybe it's because the prices went up rather dramatically and rates went up in February. But I noticed that other hot area besides ESG, thematic tech in general, is not so hot. Is there any reason for that, or will that change? They're off of their lows, but will that change this year at all? Because that was investors really, I got a lot of emails about that last year. They love investing thematically.
Yeah, we are very bullish on thematic investing and the growth of our platform that we call Megatrends within thematic investing, both index and active. And there's great offerings. I mean, you had tremendous performance from some of our exposures last year. iDrive was close to 100%. For instance, iClean that you mentioned earlier, 150%. I think that, yes, you may have a little bit of a pullback in performance, but we continue to see the flows. And about 80% of the flows that we are seeing this year are not necessarily in technology type of exposure. So the IFRA, our infrastructure offering, very timely given all the talk around an infrastructure plan in the U.S. Big flows, strong performance. iDrive, that's another area of the market where we are continuing to see strong flows. So again, I think that in thematics, we believe thematics is a long-term growth story for us and for the industry. And a lot of the things that we create, we like them to be long-term things in anyone's portfolio. We're not just chasing one-year themes. We're looking for 10-year themes. Megatrends is supposed to be about the big trends that are changing society and the economy for the next 10 years.
Yeah,
I would add, Bob.
Go ahead.
Yeah, we agree that we think that the thematics are a really great growth opportunity, a great opportunity for investors. I think Bobby touched on some of the key points. I think some of the thematics that did really well last year, but not quite so well this year. I think if you look at those tend to be very high growth type of strategies, and we've definitely seen a rotation out of growth. We've seen the flows, and we've seen the performance of value tick up relative to growth, and a lot of that I think has to do with the reopening trade and interest rates going up, as Armando mentioned. So I think some of that is kind of cyclical, and you can't divorce these thematic strategies from what's going on in the capital markets. But we do think that the opportunity set in thematics is big. We talked about the healthy hearts, the IQ Healthy Hearts. We think there are a number of we think that concept of promoting both ESG and thematic, as well as, quite honestly, a dual impact. So for Heart, we actually make a donation to the American Heart Association Social Impact Fund because we want investors to know that their dollars are doing well for their portfolios, but also doing good for society as a whole. And we think that concept applies to a number of other areas, especially in the social realm, where there are these opportunities to create these types of unique strategies.
Todd, the other big area, of course, was factor investing, what we call broadly investing by value or quality or momentum or size. A lot of these are iShares ETFs that are out there, the bigger ones. We pay attention to these that are rebalancing, that are big out there. Momentum, MTUM, which Armando runs, is going to be rebalances twice a year. And, of course, last year it was big tech names. Now it may be a little bit different. You were talking, and I were talking about this last week. What kind of changes might we see in something like some of these momentum ETFs, particularly MTUM?
Right. So momentum, the momentum ETF from iShares MTUM is the one of those 5 factor products that are U.S. focused that does not have any sector bans or any sector constraints. So it can go where the factor is strongest. Currently, the factor is strongest the way the portfolio is positioned, with technology and consumer discretionary and healthcare being heavily weighted. The last 6 months have been really strong for financials, which is little to no exposure within MTUM, and energy, where there is no exposure. So the research that we at CFRA did, we believe that we're going to see an increased exposure in financials, and we're going to see a reinitiation of energy companies. And some of the growth stocks, Amazon, for example, is potentially going to be falling out of this index. And then we're also just watching what's happening within the value ETF, VLUE, which has sector neutrality. So it's looking for the value-oriented stocks within each sector. And we saw, for example, in technology, some of the more deeper value stocks have risen, and we've seen a rotation. Some of the higher growth stocks have fallen. So we could actually see VLUE owning more of the traditional growth stocks within the technology sector, among other sectors.
Yeah, and MTUM rebalances twice a year, Todd, right? So when's the rebalancing supposed to occur now? The end of May?
So the rebalance for all 5 of the factor ETFs for iShares takes place at the end of May. The reason we're talking about this one, and we wrote about it at CFRA, is that the Momentum ETF, it focuses on the 6-month period ended April. It throws out that last month in the Momentum part of it. So the data is now, in theory, available to try to figure out where the relative strength was. But, of course, there's an algorithm that constructs this.
All right. And Armando, of course, just last question very quickly because we got to go. But you ever give thought, instead of doing this every 6 months, every 3 months, rebalancing this, given that momentum moves very quickly now?
No, I mean, momentum, by the way, I mean, Todd knows that. I mean, there's high turnover in that portfolio, so investors are aware of that. I think that what is really interesting, Bob, is in factors, which lately they don't get a lot of attention. We're seeing some of the strongest flows on the back of the reopening trade into our value portfolio and other single factor offerings that we have. So, I mean, factors is something that investors are really utilizing in 2021. We didn't see a lot of flow in 2020. That is also changing in 2021.
Yeah. Okay, guys, appreciate the help. That's it for this week's ETF Edge. And my thanks to Armando, of course, and Sal, and, of course, Todd. Armando's agreed to stick around. I've got a few more questions for the ETF Edge podcast for him. Remember, this is the guy who runs the biggest ETF fund family in the world here. You can get all of our stories, all of our shows, of course, on the main website, etfedge.cnbc.com. Anytime you want anything, just go right to that point. And remember, of course, next week we'll be back with more guests. We're going to be talking about new trends in 2021 that are emerging. I've got some interesting ideas, some interesting guests we want to talk about with that. And remember, everybody, have a healthy, happy, and safe trading week. Thanks very much for joining us.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.